So far we focused on annual coupon paying bonds, but as mentioned earlier, most corporate bonds pay interest on a semi-annual basis. So in valuing semi-annual bonds, we need to adjust the coupon payment and the number of periods, because with a semi-annual coupon paying bond, you get twice as many coupon payments, but each coupon payment is 1/2 the size of a coupon payment for an annual coupon paying bond. So we need to convert the annual interest amount to semi-annual interest by dividing by 2 and converting the number of years maturity to the number of 6-month periods to maturity by multiplying by 2. Converting the required stated annual return for similar risk bonds that also pay semi-annual interest from an annual rate to a semi-annual rate by dividing by 2. So as we can see here in our basic bond valuation method, we divide the coupon payments by 2, the required rate of return by 2, and the number of coupon payments. So which of the following is correct for a bond priced at $1,100 that has 10 years remaining until maturity and a 10% coupon with semi-annual payments? The answer is A. Each payment of interest equals $50. The interest payment, the coupon payment, is a function of the coupon rate and the par value of the bond. So the par value of the bond is $1,000, and 10% of $1,000 means the bond pays $100 per year in interest, but this is divided up between 2 semi-annual payments of $50 each. Assuming the Mills Company bond pays interest semi-annually and the required stated annual return is 12% for similar risk bonds that also pay semi-annual interest, using our semi-annual bond valuation formula yields a value of $885. Looking at this in Excel, we can do the same problem without the formula. So we have an issue date 2016 semi-annual coupon paying bond, par value of $1,000, a coupon rate of 10%, maturity in years of 10, and a required return of 12%. So if we look at the payments, 6 months from now in 2016 we'll have an interest payment of $50, which is 1/2 of the $100 per interest that we paid each year. 10% of $1,100 divided by 2. And then in another 6 months there'll be another $50 payment, and so forth. So we will have a total of 20 payments of $50 each, and at maturity we receive the par value. So on the 20th payment we will have a total cash flow of $1,050. And then as before, we can calculate the present value of all of those payments, where the discount rate is the semi-annual periodic rate. In other words, not 12%, but 6%. If you look here in the formula, you'll see we take the $50 divided by 1 plus 12% divided by 2, or 6% raised to the power of 1, the coupon payment. We convert all those payments to present values, take the sum, and it gives us $885.30, the same result that we have with the formula. So if we're using a financial calculator, we would need to convert the required rate of return, the interest rate, divided by 2, and multiply the number of periods by 2, and then the coupon payment divided by 2. So let's do an example of calculating yield to maturity on a semi-annual coupon paying bond. So we have a semi-annual coupon paying bond. It's currently selling for $1103.75, has a coupon rate of 8% and 7 years to maturity. What is the yield to maturity? Again, going back to Excel for this example, we have an issue date 2016 semi-annual coupon paying bond, par value 1,000, current price of 1103.75, so this is a premium bond. The coupon rate's 8% and the time to maturity is 7 years. So we want to calculate the yield to maturity. We first need to calculate the semi-annual interest payment, that coupon payment. Well, at 8% of 1,000, that's $80 per year. We divide that by 2 to come up with every 6 month a payment of $40. The number of 6-month periods, well, we have 7 years, so that's going to be 7 times 2 or 14 semi-annual periods. And then we can calculate the periodic rate. The periodic rate is the 6-month rate. Using the rate function in Excel, we could also use the financial calculator, have it compute the I. When we do so, that's going to be a 6-month rate because we put in 6-month interest payment and 6-month time periods. We need to convert the periodic rate to a yield to maturity because all interest rates need to be in annual format. Think about it whenever you borrow money, lend money. When we discuss interest rates, they're always on an annualized basis. So we need to annualize that by simply multiplying the 6-month periodic rate by 2. So our yield to maturity is 6.15%. Does the 6.15% make sense? It's a premium bond selling for more than $1,000, which means that the coupon rate has to be higher than the required rate of return, or the yield to maturity. And so before we even started solving this problem, we knew the answer had to be less than 8% because it is a premium bond. What is the current yield of a bond with a 6% coupon, 4 years to maturity, and a price of $750? So current yield captures the relationship between annual interest payments and the current price. So again, going to Excel to solve. Par value, so we have an annual coupon paying bond, a par value of $1,000, a current price of $750, a coupon rate of 6% and 4 years to maturity. The current yield is the amount of the interest payments per year, so 6% times $1,000 or $60 divided by the current price gives us a current yield of 8%. The current yield captures the yield from the interest payments but does not capture the capital gains yield because we would be receiving another $250 in capital gains if we purchased this bond for $750 and at maturity received $1,000. Sometimes it is not appropriate to calculate yield to maturity if a bond has a call feature. A call feature is an option for the company to refinance the bonds earlier than the maturity date. If a bond has a call feature, that will be in the bond's indenture, the bond's contract, and it allows the company, the issuer of the bond, to refinance the bond if interest rates fall. What is the expected rate of return for a 3-year callable annual coupon bond selling for $1,075 with a coupon rate of 5%, a call premium of $25, and 10 years to maturity? Newly issued bonds with similar risk and maturity are currently offering a 4% coupon. So let's work through this problem. Frequency of interest payments is annual. Par value $1,000. It's a premium bond selling for $1,075. It has a 5% coupon rate, matures in 10 years, but this bond has a call feature and can be called in 3 years. If the company calls the bond early, it has to pay a premium. In this case, the premium is $25. So at maturity, this bond would pay $1,000 in 10 years at maturity. But if the bond's called, the bond will pay the par value of $1,000 plus the call premium of $25 or $1,025. And similar bonds have a coupon rate of 4%. So the first thing we have to ask, what's more likely? Are we going to get yield to maturity or yield to call? Well, that depends on whether the bond will be called. And the bond will be called if it makes sense for the company to do that. So one way we can determine if a bond's going to be called is to look at the bond's current price of $1,075 and compare that to the par value plus the premium. So this bond is selling for $1,075 and it would cost $1,025 to call the bond, so the company will call the bond. Another way of looking at it is that similar bonds are paying 4%. This particular bond is paying 5%. So the company is paying 5% to the investors, whereas if they refinance this bond, they could get their interest rate down to 4%. So they will refinance this bond, so the bond will be called. Since the bond's going to be called, it doesn't make sense to calculate the yield to maturity. In other words, what's the yield over the next 10 years? Instead, we want to calculate the yield to call. What is the rate of return that an investor will have until the bond is called? So if we purchase this bond for $1,075 and we have 3 years to maturity, present value of $1,075 and a future value of, let's go down to the cell here and look up here, and a future value of $1,000 plus $25. We have to put a negative sign in front of the $1,075 price to reflect that we are purchasing the bond, and then the future value would be the $1,025. We let Excel do this calculation for us, and the yield to call is 3.14%. So the investor can expect, if they purchase this bond, to get a rate of return of 3.14% versus the yield to maturity, which was 4.07%.